What up, traders? It's SGS Trades coming back with another video. And today's topic is probably one of the most important concepts you'll ever learn as a beginning trader. And this concept is liquidity. And we use liquidity to help us find zones for entries for our trades. So, what is liquidity first and foremost? Liquidity are zones where it's like resting orders, and the algorithm uses these zones to seek out to build resting orders and build like bigger positions so that banks and institutions can get into a position and knock out retail traders like me and you so that they can build their bigger orders, right? So imagine you're like a big bank, right? And instead of like just putting in like hundreds or thousands or like even tens of thousands, you're trying to make a super huge position worth millions of dollars, maybe even tens of millions or hundreds of millions of dollars. You need to get a lot of people out of their position so that you can build such a big order, right? And then you use that to then make your move. So these banks and institutions often use like different methods to do this, but they basically have to knock out retail traders out of their position so that they can build up their super big orders to get into their position, okay? So where do we see liquidity, right? Liquidity often rests above either old highs like this or below old lows like this, this, and this. So, one tactic that they often use is what's known as a liquidity sweep, meaning that they'll make the price look like it's going to go in one direction and maybe even slightly break above a high or a low to trap people into thinking that the price is going to go one direction when really they're about to reverse it and send it the other direction and just trap a whole bunch of people into their position and reverse it on them. It's one of the most like wickedest and most like, I don't know, brutal ways that these people use to trap people. And I used to get caught in this really a lot when I was first starting out as a new trader, especially because I used to be what's known as a breakout artist. As in, I would like look for positions like this, and I'll be like, oh, it's gonna go higher, right? Like for example, if you look at the very top of your screen, right, where you see like those numbers changing at the very, very top. If you look on this red candle, right, the high of this candle is 6,162.25, right? So that's a high, right? And if we look on this very tiny green candle all the way to the right, it makes you think like, oh, we just got above this high because look, the high of this candle is 6,166.5, right? Just slightly, just super, super slightly went above this red candle right here. And you're thinking like, oh, we're gonna go higher. Like we just got above into this buy side liquidity over here. Okay? And this is exactly what they want you to think. They want to trap retail traders like you and me into a position just like this. Because this is the exact point to where they're gonna want to reverse it on you at. So whenever we look at these zones, we look for a couple different things. We look for one, did we break out with strength here? No. Also, did we really like sweep up and out and close above this zone? No. Because if you look here, we didn't sustain it and we actually closed below this level right here. So what does that tell us? Price is most likely going to either sweep out these lows or just retest and bounce back up. So if we look and see what happened, we can play it forward a little bit. And just like that, we test that first low right here, have a little bounce. Then on this green candle, people bought and they're like, okay, maybe we can come break out again, right? Break back up above. No. So we swept the first low and we have a lot of bearish momentum. And if we play it forward all the way, we can see price had this crazy move down. Now we swept one, two, and a third low, and then we came back, retested this previous lows resistance or previous sell side liquidity, and we even went back up even a little higher. Check the second one. But if we keep playing it forward, damn. We even swept this one all the way down here. Hold on. So look. So this move was really brutal, real nasty. The people who bought here to send it up, the people who bought here to send it up, the people who bought here to send it up, even the people who bought here and here, all just got liquidated. They all just got super messed up in their position, and they all just got pretty much knocked out of their position. And that's exactly what the banks want. They want to do moves like this so that they can not only knock them out of their position to build liquidity, they're gonna make people who bought way down here thinking that, oh, we're gonna have continuation more to the downside, right? They're gonna fake them out and then trap them into a new position to sell lower, when really they want to send the price back up, and that they were just sweeping out these lows to knock these people out of their position who bought here, 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 and here to build liquidity, and so they can send the price back in the direction that they want. So once liquidity gets taken out and we can get confirmation, this is usually where we like to place a trade on a nice retrace like this, because we have all of this nice move, super low resistance liquidity run to retrace back off of. Okay, so if we play it forward even a little bit more, right, we reverse almost instantly after sweeping out this low, and we can play it forward a little bit more. And now, like I told you guys in the other video, once we break above and we now have this high, and we break above this high as we did on this candle right here, we now have a break of structure and a change of character back to the upside. So now we've changed character, and now this is an uptrend. Okay, so we play it forward some more. We run all of these highs. We ran all of these old highs that we had, all these lower highs right here, and even, hold on, even right here. Okay, so liquidity doesn't always mean like we're gonna reverse as soon as we sweep out this low. Like, it doesn't always mean that. We have to always wait for confirmation, right? So we always want to see a change of character, like we saw down here, where price makes a low, and then a high, and then a higher low. So now we have confirmation that we're in an uptrend because we had a change of character. Instead of lower highs and lower lows, we had a high and then a lower high and then a higher high. So yeah, we always use these different levels of liquidity to look for points of reversal. So once this low gets swept out and then this low gets swept out, we know that there's a high probability that we could see a reversal, but we just need to wait for confirmation so that we can know when to actually get into the trade. Because I see a lot of the times, like, a lot of people would just instantly want to get in on the first sweep of liquidity. Like, for example, right here, if you were like to buy on this green candle right here, like some of these people did, you would have seen exactly what happened. you would have got dumped on, right? Or even right here on this candle. Like the people who bought here and then here, same story. Would have got absolutely destroyed. But if you would have waited for confirmation, as in waited for the high and then the low and then the higher high and break of structure right here, you would have been able to catch all of this move. And we measure this out from right here to right here. That's like almost a 10% move you could have caught. Okay? So this concept is super important. You always want to remember that liquidity is always resting above old highs and below old lows. And if you look right here, it respected this low almost perfectly, right? Same thing here. Like, look at the bodies of the candles. Look at the bodies, not the wicks. Respected this level, respected this level, respected this level down here. And we use these levels to help us place our trades and find our points of reversal so that we can potentially enter into a trade based on just the liquidity alone. Okay? So yeah, that's basically my video on liquidity. I hope this was helpful and I hope this was informative for you guys. And if you have any questions or have anything you maybe want me to explain deeper, or like go into detail more, maybe make sure you drop it down below in the comments. And yeah, this is SGS Trades, and I'll see you guys on the next one. Peace out.